Ladies and gentlemen, a very warm welcome to you back on Business Today Television. We are faced with a falling rupee, now at a record low of 90.13 versus the dollar. And this comes against the backdrop of fairly strong GDP growth at 8.2% for the quarter gone by, and of course, at a 6 quarter high. To discuss this and a lot more that's happening in the world of fixed income, we are now joined by Mr. Aditya Pagaria, Senior Fixed Income Fund Manager at Axis Asset Management Company. Uh, Aditya ji manages the Axis Banking and PSU Debt Fund as also the Treasury Advantage Fund, all told about 25,000 crores under AUM. Aditya ji has a very strong command on the macro and will now be discussing a great deal as to where interest rates are headed, where inflation is, and how to navigate the record low in the rupee. Namaste, Aditya ji, and a very warm welcome. Your first and opening comments on what's wrong with the rupee, consistent decline, where is it headed?
Thank you, Shailendra for inviting on the show. Yes, as we discussed, it's a very, you would say odd day where the rupee has actually broken a headline number of 90 rupees to a dollar. It has shown quite a bit of weakness, tracking obviously the dollar strengthening around the world. But 90 was something that we as market participants thought that RBI might protect, but I guess given the kind of the depreciation we have seen in last 6 months, I guess the continuous
Yes.
trade delays, trade, that we are doing with US, continuous delays on that, plus, strengthening dollar has led to weakening of Asian currencies, and obviously Indian rupee has been hit more. Uh, we think that this dollar rupee should depreciate maybe 50 paisa or something more, not more in a recent
Hmm.
in next few days or so. Some major cue would be the next upcoming policy that we have on Friday. So again, it's a very 50-50 situation
Exactly.
on what the RBI will do in terms of seeing the rupee depreciating so rapidly against the dollar. So it is a very open policy, I would say, in terms of what RBI actions will happen on the
Hmm.
Friday.
Okay, so fair enough. Let's wait till about Friday. It's not the end of the world. We are already sitting in the middle of the week, and 2 more days should see the rupee depreciate a bit more. 90.50 is where Aditya feels this should be. Let's look at the GDP number, Aditya. There has been some discussion in large parts of the market that economists. Equity and debt strategists are not really happy with this 8.2% growth. Uh, it's an inflation deflator that doesn't seem to be working. And
Correct.
the fact that, a 6 quarter high in terms of GDP was probably due to very heavy inventory stacking before the GST rate cuts. What is
Yes.
your opinion on the GDP number?
No, obviously, the market was very surprised on the GDP print. 8 quarter was something that was. We saw the surveys actually, GDP surveys. Hardly anyone was there expecting an 8+ print for this quarter's GDP. What needs to be seen is exactly 1 year earlier, the same GDP print, same quarter last year. Again, there was a surprise on downside that was close to 5.8%, if I'm not wrong. So again, there is a possibility that base effect also has come into play in terms of a higher GDP print. The base was much lower last year. As you pointed out correctly, that before the GST cuts coming into play, there was stacking of inventory across the markets, and because of that, the GDP number would have come higher. But we expect this GDP to remain closer to 6.5%-7% band going forward. Uh, we expect that RBI's expectation
Okay.
of closer to, close to a 6.5, 7% of GDP this fiscal year might remain. They might, revise it upward, seeing this quarter's
Right.
GDP. So there is a quite possibility that GDP for Q4 and maybe F5 27 Q1 might be revised higher.
Okay. Let's just shift a tack a little bit and gauge the liquidity that is there in the fixed income market. How are call rates behaving? What is your view on the short term interest rate scenario? Of course, 2 days later, the RBI governor will be discussing this broadly. But are we liquid enough as far as the daily business of the economy is concerned? Or should more liquidity be injected?
Uh, Actually, RBI has done a fantastic job in last 6 months or so. Since, if you say February or March, they have continuously been injecting liquidity into the market. Last Jan Feb it was more of closer to 5 lakh crores of OMOs. Then there was almost a 2.5 lakh crores of CRR cut in last 2 3 months. Then obviously they have been giving FX swaps to the market. So liquidity has been quite decent in past 6 months or so. As we speak
Mm.
now, after the last CRR cut that was due on the end of the month, now the core liquidity that we track actually is closer to 4 lakh crores right now. So 4 lakh crores is something that is where the market should be very comfortable in terms of the kind of deposit base we have. Closer to 2.25 to 225 lakh crores. It is easily 1.5% of the NDTL actually. So that is quite comfortable as of now. The problem
Mm.
is where we see the liquidity going ahead. So what has happened is the liquidity is comfortable right now, but we do a projection of liquidity. We have our internal models where we do project the liquidity that we might see next 3 months or 6 months. So near term, what we expect is, we have two major factors uh, because of which we expect the liquidity to tighten. First would be
Mm.
a typical, this is Jan, Feb, March is a typical time where we see a huge outflow in that currency in circulation.
Okay.
That is seasonal. So we expect around 1.75 to 2 lakh crores of incremental CIC moving out from the banking industry. That impacts the core liquidity. So it might bring it lower. So and there is RBI is continuously intervening in the USD INR market. So
Mm.
these are the two factors. I mean, this is something. I mean, this is something that we can't put a number to. I mean,
Correct.
last month we had seen almost 15 to 20 billion dollars of intervention by RBI. Obviously, it was a mix of spot. It was a mix of forwards. So very difficult to put in a number how much RBI would intend to intervene in this rupee markets. But if we expect a similar kind of intervention, I mean, 50 to 70,000 crores of
Mhm.
spot intervention, then obviously we are seeing if we add both the CIC outflow and FX intervention, the number could be as big as almost 2.5, 3 lakh crores. So a
Okay.
liquidity 4 lakh crores that we are seeing right now, it
Is
might
enough.
dwindle down to 1.5 to 1.75 lakh crores in till March. So this is something that may not bode well in terms of liquidity. So banking industry typically needs minimum 1% of 1.5% of NDTL in terms of core liquidity or what the RBI calls it durable liquidity. So to bring this particular liquidity from lower than 1%, sorry, lower than 1.5% to
Mhm.
closer to 1.5 2%, RBI might need to intervene in terms of it might be in terms of OMOs, it might be in terms of
Right.
FX interventions again on the other side. So, as far as what feedback the market has given to the RBI is more of OMO intervention, so that the demand supply gap between what demand is there in the market for GSEC and what supply is expected in Jan Feb March. There is a
Right,
mismatch
sir.
to the tune of 3.5 4 lakh crores. So this 2 lakh crores of OMOs roughly will take care of that. So it will be a two problems will be solved in by giving one solution of OMO, the
One shot.
liquidity and the demand supply also, mismatch also.
Okay. Aditya ji, let's focus on what the RBI governor might say on Friday. Now, is there a rate cut on the cards according to you? Two, how do you see the RBI address the most important 8,000 pound gorilla in the room, the rupee? What do you think is coming in the pipeline?
Fair point. As I mean, you would have seen the last month's inflation print, last printed was closer to 0.25%. I mean, seeing those kind of inflation numbers, market has actually discounted that, we are having another rate cut because, we have an inflation band where the government and RBI are more comfortable in 4 to 6% band. And your headline inflation coming to almost 0% with couple of next couple of prints we expect again will be closer to 1.5%. So these kind of inflation, actually I would put it deflation. Actually, it is not something that any central bank banker would want
Yeah,
to happen in the economy.
correct.
So, but again, a higher GDP number along with the kind of depreciating rupee we have seen, the
Hmm,
RBI policy has become a 50-50 game actually. So it's very
hmm,
difficult for us to predict that whether we are seeing a 25 basis rate cut in this particular policy.
correct.
Uh, I mean, we as a desk, we expect RBI to cut 25 basis. The market is divided as far
Okay.
as this particular thing is concerned.
Hmm,
More on the actual rate cut or no, the market is more concerned about the kind of commentary that would see from RBI, whether it will be a dovish cut or it will be a no cut with a dovish commentary. That is something what market is looking forward. And apart from that, as we discussed earlier, that OMO is something that market is expecting because the market expects the liquidity to tighten in next
hmm.
2-3 months or so. So, any comments on the liquidity management, on what RBI thinks RBI the central bank would be doing in terms of managing the liquidity? That are the cues that the market would expect the RBI to come out with. So, more than rate cut, it is more on the commentary uh, what whether that commentary would be dovish or RBI, if it signals a very hawkish commentary after the rate cut, then it will obviously a bad experience that similar to what we had in the month of June, where we had a 50 basis rate cut and a stance change. Market took it
Okay.
pretty negatively. So along with rate cut, it is more on the kind of commentary that we expect from RBI.
Aditya ji, are you worried about this, yen carry trade unwinding on Asia, especially in India, given that the Japanese 10-year yield has hit about 1.9% highest since July 2007, 2008? How worried are you, or is this just a fear in the market?
It is worrisome actually. I mean, the Japanese, I mean, as you said correctly, I mean, last so many years we have seen Japanese yields closer to zero, and now it is suddenly at 1.5% plus. The longer bonds, the 30-year Japanese bonds are closer to 3%. So these kind of yields obviously worries that we might see yen carry trade unwinding, the money moving back to Japanese economy at these kind of high bond rates. It is actually a worry, but we don't see an immediate worry of this yen carry trade unwinding because we think that dollar spending will be there in the markets. And apart from that, one of the major reasons maybe we are seeing a huge depreciation in rupee would be obviously the 10-year and 30-year Japanese yield going up also. So it is a sign of worry. Long term, if it sustains, then it is a worry for our economy. But short term, we are not that worried much on that yen carry trade.
Okay, Aditya ji, let's just stand back a bit and look at the market of fixed income in India. At this stage, what according to you would be best purchase for potential bond investors, bond fund investors? Are you suggesting low duration? Are you suggesting higher yield? What is your view?
See, again, the time horizon for which the investor is looking to invest in a fund, that matters most. For example, a low duration category. I mean, any investors who is looking to park surplus money for say 6 to 12 months of money in a particular low duration category, he can look at low duration money market or ultra short term type of fund to invest that surplus money to obviously get a better adjusted returns as compared to a traditional investment that the investors typically do. If you have a slightly longer time horizon, for example, a time horizon of more than 1 year or so, the investors can look at something like a banking PSU debt fund. I mean, it's a kind of a what we run banking PSU as a conservative, high grade AAA oriented strategy who invests in a AAA PSUs and corporate bonds, typically maturing between 2 to 5 years. So we run it a conservative fund as compared to a market. So any investors you have who has a time horizon of say a 1 year or more, they can happily look at investing in these funds who benefit from the carry opportunity on the shorter end of the yield curve. So broadly around 2 to 5 year corporate bond and PSUs.
Right. On this very somber note, Aditya ji, we'll call it a day. And all eyes and all ears are peeled to listen to what the RBI Governor, Mr. Malhotra, would be saying on Friday, 10 a.m. With that thought in mind and hoping that the rupee will stage some kind of a recovery, we'll call it a day. Thank you for joining us, sir.
Thank you so much, sir. Thank you.
That, ladies and gentlemen, was Mr. Aditya Pagaria, Senior Fixed Income Fund Manager at Axis Mutual Fund. Thank you for watching.